Alright, so you're thinking about investing. That's awesome, seriously. It's one of the best ways to build wealth over time, no doubt about it. But here's the deal, and I see this happen way too often. People get excited, they hear about some hot stock or a guaranteed return, and they just jump in head first without really thinking it through. And that, my friends, is usually a recipe for losing money, or at least not making as much as you could. I've learned this the hard way, and I've seen countless others learn it the hard way too. So let's try to skip that painful learning curve, shall we? Before you make any investment, it's crucial to take a few important steps to ensure you're making a wise decision. Let's dive into the top 5 things you should do before you invest your hard-earned money. Think of this as your pre-flight checklist for your financial future. You wouldn't just hop into a plane and hope for the best, right? Same thing applies here. We're talking about your money, the stuff you worked hard for, so a little bit of prep work goes a long way. And trust me, these aren't complicated high-level Wall Street secrets, they're practical steps anyone can and absolutely should take. We're going to break down each of these 5 things step by step so you know exactly what to look for and why it matters. My goal here isn't to tell you what to invest in, because that's a personal decision, but to equip you with the how to approach investing intelligently, how to protect yourself, and how to set yourself up for the best possible chance of success. So, grab a coffee, maybe a notepad, because these are the fundamentals that could save you a ton of headache and potentially make you a lot more money in the long run. Let's get into it. Okay, first things first, and this one is absolutely non-negotiable. You have to research the market thoroughly. I can't stress this enough. So many people skip this step, or they do what I call headline research. They read a catchy article title and think they know everything. That's not research, that's just asking for trouble. You need to dig deep. What I mean by this is gathering as much information as humanly possible about whatever it is you're considering investing in. Is it stocks, bonds, real estate, a specific crypto coin? Whatever it is, you need to become a mini expert on it. Understand the industry it's in, the specific company or asset, and the broader economic factors that could affect it. Don't just take someone else's word for it, not even mine. When I say look at historical data, I mean really look at it. How has this investment performed in the past? Not just last week or last month, but over years, even decades if possible. What happened during different economic cycles like recessions or boom times? This isn't about predicting the future with 100% accuracy, because nobody can do that, but it's about understanding patterns, volatility, and potential downsides. Then look at current trends. What's happening right now? Are there new regulations, new competitors, technological shifts that could impact your potential investment? Is the sentiment around this market positive, negative, or just plain confusing? You need to be aware of the present landscape, and finally future projections. Now this is where it gets a bit speculative obviously, but you need to look at what analysts are saying, what the company's own guidance is, if it's a stock, and what the general outlook for that sector or asset class looks like. Are there growth catalysts on the horizon, or are there potential headwinds that could stall progress? The more information you have, from historical performance to current events to educated guesses about the future, the better equipped you'll be to make a smart decision. This isn't about finding a crystal ball, it's about making an informed choice based on evidence, not just a gut feeling or a hot tip from your cousin. Alright, next up, and this is super personal. You need to understand your risk tolerance. This basically means figuring out how much financial pain you can actually handle before you start freaking out and making bad decisions, like selling everything at the worst possible time. Investing always involves some level of risk, there's just no way around it. Anyone who tells you otherwise is probably trying to sell you something sketchy. So, the key is to assess how much risk you personally are willing and able to take. This isn't about being brave or a daredevil, it's about being realistic with yourself and your financial situation. Think about it this way. If your investment dropped by 10%, how would you feel? What about 20% or even 50%? Would you be able to sleep at night, or would you be constantly checking your portfolio, heart pounding? Your emotional reaction to potential losses is a huge part of your risk tolerance. It's not just about the numbers, it's about your psychology. Some people are perfectly fine with wild swings because they're aiming for higher potential returns, while others prefer a slower, steadier approach, even if it means smaller gains. There's no right or wrong answer here, but you absolutely need to know where you stand before you put your money on the line. This self-assessment will directly help you choose the right type of investments. If you're highly risk-averse, you'll probably lean towards things like bonds, dividend-paying blue-chip stocks, or diversified index funds with a long track record of stability. If you have a higher risk tolerance, maybe you're looking at growth stocks, emerging markets, or even more speculative assets. But aligning your investments with your comfort level is crucial. If you invest in something that's way too risky for your personality, you're likely to panic sell during a downturn, locking in losses. Conversely, if you're too conservative and have long-term goals, you might miss out on growth opportunities. So be honest with yourself. What's your ouch point? Chapter 3. Step 3. Don't put all your eggs in one basket, the magic of diversification. This next one is a classic piece of advice for a reason. Diversify your portfolio. You've heard the saying, don't put all your eggs in one basket, and in investing, that's gospel truth. Seriously, this is one of the simplest yet most effective ways to manage risk. Imagine you put all your savings into one single stock. If that company does amazingly well, great, you're a genius. But what if it tanks? What if there's a scandal, or a new competitor crushes them, or their main product becomes obsolete? Your entire investment could be wiped out, or at least significantly damaged. That's a massive gamble, and it's one you really don't need to take. Diversification is all about spreading your investments across different asset classes, industries, and even geographical regions. The idea is that if one part of your portfolio is having a bad day, week, or even year, other parts might be doing okay, or even great, and that can help cushion the blow. For example, you might have some stocks, some bonds, maybe a bit of real estate through a REIT, or even some exposure to international markets. When stocks are down, bonds might be up, or vice versa. It's not about eliminating risk entirely, because again, that's not really possible, but it's about smoothing out the ride and protecting your capital from the catastrophic failure of a single investment. Think of it like building a sports team. You wouldn't want a team full of only quarterbacks, right? You need players with different skills and roles to create a balanced and resilient team. Your investment portfolio is the same. You want a mix of assets that behave differently under various market conditions. This doesn't mean you need to own hundreds of different things, especially when you're starting out. Even a few well-chosen diversified index funds or ETFs can give you broad exposure to different markets. The key is to not be overly concentrated in one area, because that's where the real danger lies. Spreading it out is just smart. Chapter 4. Step 4. Phone a friend. Well, a financial advisor maybe. Alright, so you've done your research, you know your risk tolerance, and you're thinking about diversification. What's next? Well, for some people, especially if you're feeling overwhelmed or dealing with a complex financial situation, it might be a good idea to consult with a financial advisor. Now, I know what some of you are thinking. Graham, aren't financial advisors expensive? And yes, some can be, but not all of them. And sometimes the value they provide can far outweigh the cost, especially if they help you avoid big mistakes. The key here is seeking professional advice to get a second opinion and ensure you're making informed decisions. A good financial advisor can help you clarify your goals, assess your risk tolerance more formally, and create a personalized investment plan. They can also explain complex investment products and strategies in a way that makes sense to you. Think of them as a coach or a guide. However, and this is a big however, you need to be careful about who you choose. You want to find a fiduciary advisor if possible, which means they are legally obligated to act in your best interest, not just sell you products that make them the highest commission. Ask them how they get paid. Are they fee-only, fee-based, or commission-based? This is really important to understand. Don't just blindly follow everything an advisor says either. They're there to advise, but ultimately, the decisions are yours. Ask a lot of questions, make sure you understand their recommendations and the reasoning behind them. If something doesn't feel right, or if they're pushing you into investments you're not comfortable with, it's okay to say no or get a second opinion from another advisor. The goal here is to get an objective perspective from someone who understands the landscape, not to hand over control of your financial future completely. For many, especially those just starting or with straightforward needs, you might be able to manage on your own with ETFs and index funds, but it's an option to keep in mind. Chapter 5. Step 5. What's the end game? Align investments with your goals. Finally, and this ties everything together, review your financial goals. Before you invest a single cent, you need to be crystal clear on your investing. What are you trying to achieve? Are you saving for a down payment on a house in 5 years? Are you planning for retirement in 30 years? Are you trying to build a fund for your kids' education? Your investment strategy should look very different depending on these goals, especially the timeline. Investing without a goal is like driving without a destination. You'll burn a lot of gas and probably end up somewhere you didn't intend to be. Make sure your investment choices align with your long-term financial objectives. For example, if you need the money in the short term, say within 1 to 3 years, you probably shouldn't be putting it into highly volatile growth stocks. You'd want something much safer and more liquid, like a high-yield savings account or short-term bonds, even if the returns are lower. The risk of losing your principal when you need it soon is just too high. On the other hand, if you have a very long time horizon, like for retirement, you can generally afford to take on more risk for the potential of higher returns because you have time to ride out any market downturns. And this isn't a set it and forget it forever kind of deal either. Life happens. Your goals might change. You might get married, have kids, change careers, or inherit some money. That's why it's so important to revisit and adjust your goals and your investment strategy periodically, maybe once a year or whenever a major life event occurs. What made sense for you 5 years ago might not be the best approach today. So, regularly check in. Are your investments still on track to meet your objectives? Do your objectives even make sense anymore? This ongoing review process ensures your money continues to work effectively for what truly matters to you. So there you have it, the 5 essential things you absolutely need to do before you start investing. We've covered researching the market like a pro, really understanding your own comfort with risk, the magic of diversification, not putting all those eggs in one basket, when and how to consider a financial advisor, and critically, making sure your investments are actually working towards your specific financial goals. It might seem like a lot, but trust me, taking these steps up front will save you so much potential stress, and more importantly, potential losses down the road. This is about being smart, being prepared, and taking control of your financial future. By following these steps, you'll be better prepared to make informed investment decisions. Remember, investing is a long-term journey, so stay patient and stay informed. Happy investing. It's not a race, and it's definitely not a get-rich-quick scheme, no matter what anyone tells you. The people who build real sustainable wealth through investing are the ones who are disciplined, consistent, and who understand these fundamental principles. Don't let the noise or the hype distract you from a sound strategy. Keep learning, keep reviewing, and keep your eyes on your own goals. And if you found this helpful, you know what to do. Smash that like button for the YouTube algorithm. It really does help out the channel. Consider subscribing if you want more content like this, breaking down personal finance and investing in a way that, hopefully, makes sense. Let me know in the comments below what your biggest investing questions are, or what topics you'd like me to cover next. Thanks so much for watching, and I'll see you in the next video. Before we wrap up, I want to emphasize one more thing. Keep the momentum going. If you find this video interesting, be sure to like, follow, and share with friends. Your journey doesn't end here. Stay engaged, keep learning, and be proactive about your financial education. The world of investing is vast and ever-changing, and the more you know, the better equipped you'll be to navigate it successfully. And remember, every small step you take today is a big leap towards your financial future. So, stay curious, stay diligent, and don't hesitate to seek out new information and perspectives. Investing is as much about personal growth as it is about financial growth. So, what's your next step? Maybe it's diving deeper into a particular market, maybe it's finding the right financial advisor, or maybe it's just continuing to educate yourself. Whatever it is, take it with confidence and enthusiasm. Thank you for being a part of this journey with me. Until next time, keep investing smartly and wisely. See you soon.